Alright, now we're going to talk about moving averages. If you're going to go on top here where the indicators are, and we type moving average. See how there's two main moving averages? There's a simple moving average and then the exponential moving average. Now the difference on both of these is that the mathematical equation they're used to calculate both of them, the exponential one, it's going to take into account more of the recent price action. Therefore, it's better to use when utilizing it for shorter time periods or shorter movements instead of the moving average, which is going to be used for bigger time periods, okay, more of a swing trading type of setups, okay. So the exponential one, you can use it for more of a scalping or day trading as well, or catching those small movements, okay. Now, I've got them plotted down here for some of the most used ones. I'm going to write it down here. So for the exponential ones, we've got the 12 and the 26. And for the simple ones, we got the 50 and 200. So let's start with the EMAs. I'm going to take the other two out so it's a little more clean. Alright. So what we're looking for is the shorter EMA to cross over the longer EMA. So in this case, the 12, we want to see the green go over the red. Will give us a bullish signal. And then if the shorter crosses under the longer EMA, then it's a bearish signal. It's a sell signal. Now, what do these numbers mean, 12 and 26? Well, what that means is that it's going to take into account the last 12 candles, okay? And that's how it's going to plot out the line for you. And the same with the 26. It's going to take out the last 26 candles. And it all depends on the time frame that you are. So if you're in the daily, it's going to take the last 12 daily candles. If you're in an hourly, it's going to take the last 12-hour candles. So the shorter the time frame you utilize this, the more signals it's going to give you, because there's going to be more price action. Now, let's take a look here. What happened right here? See how when the price went all the way up here, it crossed the green over the red, and right when that happened, you got a nice rally. See? So that will be a bullish signal right here. There will be a buy signal, and it stayed over the red all this period. So you can see right here, it tried to touch and went under, but it didn't, so it just bounced off the red one again, off the 26. Stayed all the way up here. See? He tried to do it again, but it didn't actually cross over, it just bounced. Bounced over again, bounced here again. See, all the way here, and then until it actually then it crossed over. So $660. There you go. So only with that signal, you could have stayed in this trade from $300 all the way to $600, which is a lot. It's twice as much. I lost it right here. So only with that signal, you could have done that. It's very good, actually. Now this is a daily. You can also look at 4 hours. See if we can give us more signals. For example, let's start off right here. So if you're going to utilize the bigger time frame like a daily, it's more like a swing trade. And then if you go lower, you can go like hourlies or shorter trades. It's going to give you more trading setups. Oops. Look at the same amount. Start at 300. It's way longer now because we're looking at hourly. Okay. There you go. So let's say the hourly here. See what happens. See how it crossed here with 500, let's say, and then it crossed down here right after $100 more, which is still pretty good. I mean, it's a $100 move. And then it crossed down, and that will tell you a sell signal. But then what happens? It crosses over again right after this, gives you a buy signal. And it only moved, what, $60, $20, and then it gives you another sell signal. So the smaller time frame you go, you're gonna get a lot more trades. So I would just recommend, for a swing trade, just go on a daily and utilize it on a daily chart or a 4-hour chart. That could work as well. And then we want to take a look at the simple moving averages, which are going to be used for even longer time frames. So let me take this EMA and this. No, not that EMA. Okay. There you go. So we have the 50 and the 200. So the 200 is the purple one, and the 50 will be the yellow one. Now, 200 daily moving average is very important in technical analysis. Is usually the line that separates a bull market from a bear market. Okay. So when prices are under the 200 moving average, it's going to be pretty bearish. And if they're going to be over the 200 moving average, which is the purple one, it's usually a very bullish sign. Okay. Now the same way we're going to look at this is with the crosses. So since the 50 is the yellow one, the smaller, the shorter one, we want to wait for it to cross over the 200 for a buy signal. And then if it crosses under the purple one, it's going to be a sell signal or a bearish signal. Now here we got a buy on our 300 again. And then see what happened here. It crossed under, but it quickly went all the way back up. So even if you sold here and then you rebought it back here, you'd still be good. The same for the swing trade. You just keep going up, skip all the way up. It didn't tell you to sell on the 600 like it did on the shorter ones. So you just kept being over the 200 all this time. All the way up here, we're still over it. So it would have told you to buy at 300 and you would have still held it until now, which is $1,700. It's pretty good. If you only take into account that, you could just swing trade this all day and just keep an eye on those big moving averages. That's a very important ones, but they also serve as support and resistance. Okay. Now, if you look at this, here, since the price is over it, you want to look for it as a support. Okay, it's a support line, the 200 moving average. So here it worked as support. Here, it came down here, barely touched down here as well. So it'll be a dynamic support. Okay, even the 50 is going to work. See how it bounced right here. Okay, so many times. Right here, utilize it as support all the way up. Right here. Now sometimes you get this fakes out where it breaks it down, but it quickly goes all the way over it. So that's a bullish signal. When you see that fake out, when you see the price go under and then it quickly goes all the way back up, that's also a bullish signal you've got right here. But if you only worry about the crossovers, you could just swing trade it that way. Just wait for the crosses to happen. Now in technical analysis, this is called a golden cross when the 50 goes over the 200, and then you've got the death cross when it goes under. Well, you have to look at the price action, see if it actually goes back up again. Okay, because it also could be a fake out. So that's something to keep an eye on. So let's recap. We're going to use the 12 and the 26 for the shorter time frames, the shorter trades, and the 50s and the 200s for the longer swing trades. and wait for the crosses. For the shorter to cross, the longer to the upside, that's a bullish signal. Or if the short crosses the longer one to the downside, that's a bear signal. That's a sell signal. Okay, thank you.